Hello my fellow freedom builders and welcome back to the channel. Now today I actually did plan another video, but you'll get that tomorrow. Today I have something I need to get off my chest because the last couple of days I have been reading about Michael Burry, known from The Big Short, that he just bet $1.6 billion on a stock market crash, and we can hear all about it from CNN Business, or we can search on YouTube and we can see the big stock market crash incoming. Michael Burry's Big Short 2.0. Michael Burry, new Big Short investment update. Michael Burry makes $1.6 billion bet on stock market crash. Big Short investor Michael Burry bets on Wall Street downturn. And we can go on and on and on. Michael Burry bets against the market crash incoming. Well, it just keeps going. And the things that really annoys me here is that the people here, when they make titles like this, and the most scary part is actually that CNN Business makes title like this, and I can see it in Denmark, where all the financial medias have jumped on this bandwagon as well, talking about how Michael Burry is predicting a crash in the market. The scary thing is that he isn't. Or at least we have no idea if he is. First of all, how do we know that Michael Burry is so quote-unquote betting against a crash in the market? Well, we know that from the so-called 13F listings. And in these 13F listings, we can see all the major investors, all the funds, what they are investing in, and so on and so forth. The problem is, first of all, these are old listings, meaning that they are from Q2. So these are the investments he made from 1st of April to 1st of July. So first of all, he can already be out of the position, or even if he were betting, he could get it all completely wrong, or we could be completely late to the game. So that is where they get it from. That is the 13F portfolio. This is basically old news. Doesn't mean that we can't learn a lot from it, but if he bet on a market crash, he did it at least 1.5 months ago, because it's 1.5 months since the Q2 ended, but it could also have been data that is 4.5 months old. So that is the first part. This is old news. Secondly, and this is the worst thing, the thing that he has been buying put options to quote-unquote hedge himself from a market crash actually does mean what people think it means. So let's have a quick look at it. First of all, here is the S&P 500 or the SPY ETF. That is one of the ETFs that Burry has used to buy options against SPY options. I'll get into the SPY option part in just a second because that is a little bit technical. But this is the time period where he bought the put options. This is Q2 this year, so this is what we're looking at. Now, when we are looking at options, and here is where it gets a bit technical, but I've made some videos about it before and I'll make some more. But when you buy an option, there are different variables. First of all, there is an expiration date, meaning that you're buying an option. And when you buy an option, by the way, you buy the right to do something. For instance, if I buy an option, a SPY option today on SPY, I buy it at a strike price of 400. That means that if the stock market drops here, I get the right to sell someone my SPY ETFs in the future at a price of 400, even if it goes to 300, or I can sell it at 400, even if it goes to 300 or 200 or 100. I'm 100% certain of the price I am getting. So when you're buying a SPY option, it is kind of an insurance if the market should crash. So this far, the financial media has got it right. Now, a strike price is not the only thing you need. You also need an expiration date. So if, for instance, Michael Burry bought the put options here, we have no idea if he did, and he said, I want some insurance if the stock market should go to, if the S&P 500 should go down here, or the SPY, to, let's say, 360 or 380, and I am doing it with an expiration date late August, late July. There's several dates each month you can have expiration date, but that means that if the stock market tanks and goes below 350, let's say he bought the put option here, if it goes below 380, sometimes before the expiration date, then his hedge works. However, if he buys it and the stock market drops the day after his expiration date on the options, his hedge didn't work and he would have spent some money on an insurance that he just loses. Alright, so far so good. That is buying a put option. That is buying insurance if the market should drop. Now, the thing about options is that they are a bit complex in the pricing. And one of the very big part of the pricing of an option is something called volatility or implied volatility. That means that if, for instance, you want to buy a put option on, let's say, Nvidia stock the day before the earnings comes out, then the market is not sure what to expect because earnings are coming out. It could go up 30%, down 50%, whatever. So the insurance you will have to pay to make sure you can get a certain price will skyrocket. So if you're buying a put option when the volatility is high, you're paying a higher price for the put option. If you're buying when the volatility is low, you are getting a cheaper put option. However, if at some point the volatility goes up after you bought the put option, then you'll make money simply on volatility. Doesn't even matter if the market moves. Let me show you on a graph here. I'm using something called Option Strat. It's a neat little website that is fairly cheap on in their subscription. And what I've said here is I'm looking at SPY. That is, of course, the ETF on S&P 500. I can only do it for today, so you can see this dotted line. That is the price today. That is 439.62, or should I say the price yesterday at closing. If I want to make sure I can get 400, and let's go back here. I want to make sure I can get 400, and I'm putting an expiration date on it, like 20th of October, for instance. That is just as an example here. Then we can just scroll out and I can say, okay, 20th of October, that is here. So if the S&P 500 or the ETF here, SPY, drops below 400 before my expiration date, then I am making money because my put option is getting worth more. Many options are being bought and sold many times before expiration date, because if all of a sudden my option gets worth a lot more, then I can potentially sell it for a profit. Then of course I am not insured anymore, but that is how it goes. All right, so far so good. In this case here, I am buying a put option for October 20th, and I'm doing it at a strike price of 400. Now what we can see here is a bit different than what you normally see on the stock chart, but you can see the current price here. You can see my price where I'm insured here. And what you can see is that I am buying this put option at a very low price, meaning that I am putting down a net debit per contract at $265. That is the red line. You can see the white line down here is the break even. The red line, that is, we can just do it like this. You can see the white line, that is 0%, that is break even. And the red line is where I have lost 100% of my $265. Now, remember that Michael Burry, he is investing something like in 20,000 contracts of these each, but this is just to make a point. All right. What happened if the market drops and we are just at the end of we let the option run out? If the market drops to, for instance, 340, you can see we are making 2,000%. But the market has to drop 23%, but we are 20x our money here. And remember, the 265 is on a about 440 or $44,000, because all of them is 100 ETFs here. So on approximately $44,000, I'm paying a couple of $100 on that. That is something like 0.5%, 0.6%. So if Michael Burry did this today, he would not be risking his entire portfolio. He's not short his entire portfolio, as someone is saying. He's buying a hedge if the market should drop, and he's paying something like 0.5% of his entire AUM, asset under management. However, if the market drops and he loses on many of the position he has, Expedia here, and what is this one? I can't even recall what that is. Oh yeah, Charter Communication and so on. Then he'll be losing on all his stocks here. However, if he had risked, for instance, 0.5%, and that is 20x, then he's making 10% of his entire portfolio just on this put option. Now, this is one thing. He might have bought this. It might have expired already. We don't know when he bought it, what price he bought it at. But a very important thing here is that the volatility is a big part of the option price, as I mentioned. And if we try and have a look at the VIX, that is something normally in the media called the fear index. But it basically just it calculates the 30-day variance on the basically on it's a volatility on S&P 500 measured over a year. And if we look at the S&P 500 here, we can see it has gone up. If we look at VIX, the VIX index here, we can see that while the market went up, the VIX index went down. However, there are times here where the VIX index was fairly low and then went up massively here. Here went up massively. Here went up massively. And when I'm saying massively, I'm saying something like, for instance, here it went up 36%. Here it went up 35%. And lately here it went up something like 40%. So let's have a look at a potential option play for Michael Burry, because he knows that when the VIX is very low, there will be a boost at some point. And it can be a bit tricky if you have a big position to actually trade the VIX itself. So what you can do when you know that VIX is a part of the S&P 500 volatility is a part of the calculation for VIX, you can actually take an S&P 500 position if you want to speculate for a heightened VIX return or heightened volatility level in the market. So let's have a look at this. Here we have the pricing at the end of the until the October 20th here. But let's take this back. This is actually how it looks now. If I enter the option contract right now, I'm in break even, and if it all of a sudden drops, I'm in a profit. If the S&P 500 goes up, I'm losing, but I'm not losing everything at once. That is how the pricing of the options work. However, down here you can see implied volatility, 22.3%. If that goes up by a third, let's say it goes up to 30, that will be something like a third, 7 or 8 percentage points here. Then look what happened to this line here. Right now we are in break even, but look what happens if the volatility goes up. Meaning I just bought an option that was fairly cheap because volatility was low. But even if S&P 500 is not moving out of the place, but if volatility is rising, then I am making 130% on my $265. And then of course the market can drop. Let's say it just dropped 5%. We can see that here, 5%. At a 5% drop and a spike in volatility, I'll be making 350%. So if I risk, for instance, 1% of my entire portfolio, I would be making 3.5% on my entire portfolio just from this simple, cheap option play. So if we're looking, and I should say I have great respect for Michael Burry, he's absolutely not stupid. So what he might have done is that sometime in this time period here, he have taken a position when he thought that the VIX was fairly low and was about to go up. And he has actually potentially made 3, 4, 5% just on volatility going up. If we take a look at the S&P 500 again here, there are several instances here where, for instance here, the market dropped 2.5%. There is here, the market dropped 2.6%. There are instances here where if we go back and I know this is a pricing today, we can't compare it directly, but if you just kept this trade for a few days and the market went down to 2.6%, he would have made 220% on his volatility play. So, in short, is Michael Burry actually thinking that the market will crash? Well, I have no idea because I don't know what he's thinking. Will the market crash? I don't have any idea because no one can predict the future. But the world going completely crazy about Michael Burry because he had bet $1.6 billion that the market will crash. Well, he didn't bet 1.6 billion. He probably took some very far out of the money put options, bought them sometimes out with expiration date, sometimes out in the future. We don't know if it's 3 months, 6 months, a year. We have no idea. But he could have just been in it for a few days and then exited again. So, and he could even have lost his money because maybe the expiration date was somewhere in the area here. And the market just went up and he didn't get out of his position, and he could have lost 1% of his money and be out of the option position. So in short, no, Michael Burry's, or at least we cannot see from the 13F reportings that Michael Burry's think the world is going to crash and the stock market is going to crash. That is just utterly bollocks. And what I think is that either all of the financial media haven't got a clue of what they're talking about on just some basic option knowledge, or they know what they're talking about, but they also know that this Michael Burry world crash 1.6 billion is selling a lot of tickets. It's basically either clickbait or it is a sign of utterly stupidity among the financial journalists. And I suspect that there are a bit of both in it in the different medias. But this is my take on it. This is not Michael Burry saying that the world is going under, or at least we can't know if it is that. This is basically just some spies and some cues, option being bought, some put option being bought sometimes out in the future, and it could easily just be a bet on volatility going up and not on the market crashing. Oh, alright, I got it off my chest. I'm sorry for this a bit long rant, but it took a bit of explanation and it is a bit technical. For those of you in Denmark listening to this, I am planning some option training. So if you are interested, you can leave me an email or something on Facebook or so on. I'm doing a bit of training on the strategies I'm using with options, but yeah, don't fall for these clickbaity headlines. The world is probably not going under. Sorry. Alright, that's all for now. Take care of yourself and your money out there, and if you have questions to any of this or to options or anything, feel free to drop me a note. Alright, speak to you shortly. Bye.